All right, next episode. Happy Monday morning. Shout outs to our guest and my co host, Ed. Ed, who do we have on the call today?
Today we have Heather Twardus of WFG Title. Yeah, she is the ninja, by the way, to continue that theme of title.
As a lot of you folks know, there's three working parts in a real estate transaction. And for a lot of our folks that are maybe not as familiar with the real estate process, in any given real estate transaction, you have the realtor, you have your title side, and you have your lending side. And all three of us work together to make that engine run. It's kind of like a wheel on a car going forward. We all work together simultaneously through this process. And I will allow Heather. Heather, it's great to have you. I'll
Thank
let you
you.
introduce yourself.
Oh yeah, I'm Heather Twardus. I've been in the business for over 20 years, and I'm with WFG National Title Company in Campbell, but I'm also remote. So we're a national company. We underwrite our own title insurance policies, and we have our own escrow teams nationwide.
Nice. Okay. Well,
Yeah,
it's amazing to have you, Heather. I'm glad
thank
that
you.
we have all sides of of the real estate transaction here present.
Yes.
There's a lot of things going on in the market today. It's shifting so often. And I realized how many more times I'm talking to my coach because of all the changes and how we pivot with those
Mm-hmm.
changes. So
Mm-hmm.
we three, all of us are going through really interesting times in the market. We started out with something during the pandemic that was, as my man Logan Motoshami at Housing Wire calls, a savagely unhealthy market with these artificial rates. Ed, I know you call those rates. What did you call them? It was like free money. You're like free lunch.
Yeah, it was it
Oh,
was it was free lunch. I mean, and we all know that there is no such thing as free lunch. It was really technically a subsidy by the Fed, and now the party's coming to an end. And look, at some point, you got to buy your own lunch. You got to pay the lady.
yeah, yeah. I mean, we love seeing our home prices going up, especially if you're a homeowner. Every time you open up a HomeBot or a Zillow, Zestimate, you see 10, 15, 20%. In Austin, in Boise for a certain amount of time
Nice.
last year, 30%, 35%, right? And as you had reported, you had noticed in Tampa, right? These year over year growth. Of course, people like to hear.
34%.
But listen, if we have 30% growth every single year, that's just bonkers. That's not
Not
sustainable, right?
sustainable. No.
So as much as I love the business, and I'm sure shout out to all my lenders, right? Especially my number one, my preferred lender at DS, you love a lot of the business as well. But if we take a step back and really look at a high level overview, it's a really unhealthy housing market. And they had to do something because there's just no ceiling, right? And
Yeah.
it's going to take a hit with transactions, right? When you increase the rates as much as the Fed has. But they kind of had to do something like that, right? Because it was just running wild. Correct me if I'm wrong.
No, 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 you're absolutely correct. And here's the thing is that those kind of things are not sustainable. They do that in order to keep us from going off the economic cliff, right? But that's not something that happens a forever thing. It's not
Right.
a perpetual subsidy. I mean, if you look at back in the 80s, let's put it into context, well, rates went up to the 30-year fixed peaked at 21%, and then that same year it went down to 13, and everybody thought that was free money. Well, the Fed in
Yeah.
those years, it was Paul Volcker. He had to do it in order to make sure to tame the beast, which in this case we're talking about inflation. And here we are again, right?
Yeah, yeah. I've been hearing his name thrown out at a few of the real estate podcasts that I listen to, and every single time they mention his name, I think about you, because I remember you told me about who he was, and you broke it down. You said he's like some 6 foot giant, and
Oh,
it's
he's like seven
so,
feet, something like that. He was, I think, the tallest Fed ever by a ton. But he was also huge in brain trust. This man was a very, very smart guy, and he knew that he had to do what he had to do and inflict a little bit of pain on the economy for the greater good. And so here we are now. In my opinion, we're a little bit late. Our Fed was a little bit late to raising rates. Probably should have done it smaller increments 18 months ago, but hey,
yeah,
can't cry over spilled milk. Here we are. And the reality is that the party's got to come to an end at some point, and cycles are real things. You can't just eliminate cycles. We are in another one. And look, you tell me, I mean, we're kind of in a normal market. I mean, if you look at the average 30-year fixed interest rates between 6 and 7%, and here we are with what, averaging 5 to 10 offers on a home, You know, you don't have Berkeley going $1 million over like it was.
That's
You know, I
true.
think
I
it's
remember that one.
normalizing, right?
Yeah. Yeah, yeah, and even right now, and oh my God, what's going on with the housing market? Everything is so slow. Nima, did you see that property? It was sat on the market for 2 weeks. Oh my God, 2 weeks. No, I'm
I
sorry. I'm
know.
being facetious here.
Sure.
Just like you said, Ed, right? Something like 30 days is regular, right? That's a normal market. We have to be mindful. Everyone sees inventory. You see the headlines that say 30% more inventory this year than last year. People thinking, oh my God, housing crash, bubble bros again at it. But let's remember, the inventory is still significantly lower than it was in 2019.
Absolutely.
That wasn't
And I
a
think the
heavy.
average days on market is 18 days still.
Yeah.
So we're not even talking, Nima, about 30 days. Okay, so it was 12 days. It's 18 now. Not a huge difference, folks. There is
Right.
no bubble.
No, no. And I really believe it's when you price the homes right. Sellers can't be as greedy, right? During 2020, 2021, you could have asked for the moon. And somehow you can try to negotiate it, right? And still get that, as you had mentioned, Ed, right? That party's gone now. But I still believe if a home is priced well, and especially if it's in a desirable neighborhood, i.e., great schools, you'll still get a ton of activity. I mean, we all know in our area, especially, my personal belief is that the decrease in the stock market affects our buyers a lot more than the increase in rates, because so many of them, from what I see, they use those vested stock options as their down payment. Then all of a sudden, with their high tech salaries, the mortgage rate is very easy to deal with on a monthly basis. But since that has dropped so much, right, the tech stocks, I feel like that's really what's affected our area. Now, that being said, on the Cupertino and San Jose border, we have a listing in Cupertino proper with Cupertino schools. I held that open house this weekend. On Saturday, I had 61 groups, and on Sunday, I had 40 groups. And I did not do
Wow.
And we're talking about groups, folks. We're not talking about
groups.
individual people.
Yeah, whether it was one person or a family of five, I labeled them as one. So we had over 100 groups. And like I said, I didn't do a taco truck. Sometimes I'll do a mega open house if it's in my farm, where I'll have a lender come by. I'll have, the whole shebang. I'll bring a taco truck out, catering food. None of that. And we still had that many groups. So it shows that when you still price a home effectively, there's a ton of interest. And it was the first time since May, when the rates started going up, that I had multiple people asking me if a preemptive offer situation was possible. That was interesting.
Oh, that is fascinating. Okay,
Yeah.
so let me jump into this real quick.
Mhm.
Okay, so for those of you who think there's a bubble, well, here's your example, right?
Yeah. Yeah.
That's not the case. But here's the other part is that people who do or who can do. Notice that all these people showed up. And by the way, by the time they show up, Nima, they've already seen the property. Let's be honest. They've gone on all the websites, they've looked at all the virtuals, they looked at all the pictures, and they're still going to the property to see it. So talk about people who are really interested.
Yeah. Oh, yeah, absolutely. And Heather, I have a question for you. Ed and I can literally sit here and nerd out over these numbers or like open house attendees. We do this all the time together, just because
Uh-huh.
right with the pulse on the market. Now, what are you seeing from the title side? Like, are you seeing, like, let's just say, compare with me, please, year over year from 2021 to 2022. How busy has WFG been? Are you able to breathe now, finally? What's going on with that?
Okay, so yes, we are comparing the years 2019, 2021, and now. Okay,
Mhm, mhm,
so we are actually comparing 2019.
mhm,
So 2019, before of 2020, the refi boom came
mhm.
about 2 years ago. Well, before that, there was really not any more refis, but our listings are going up. Okay,
Mhm.
so we are comparing of 2019. But yes, we have dropped tremendously of the refinance business, but we are getting a lot of traction now of opening escrow with us in our
Okay.
company. And we actually offer 25% off anyone over 55, military or a veteran, and new
Oh,
homeowners
wow.
because they're loving that. And we have seen a tremendous amount of renegotiations, which isn't too bad. I mean, it's still, I think the one that I've actually thought was interesting, they had to lower it down 200,000, and that was actually in Morgan Hill.
Mhm,
And then also in Willow Glen, they had to fall out of contract because they didn't like the interest rate. But it went right back in within a week with another buyer. So we're not, doom and gloom here. It's just adjusting to what the prices are of fitting the lifestyle of the person that wants to purchase the property.
Right. Kind of like similar to what Ed just said, right? We're just in a normal market right now. That happens all the
Exactly.
time, negotiating for things. I recently did an off-market transaction where the seller elected to not do inspections. I always recommend doing inspections from the beginning because you want to disclose as much as you possibly can. These are things that I've learned from my father, who's been in the business since the 80s, how important it is, right? Just to disclose, for lawsuit, whatever. Now we came back and the foundation was all messed up. So we were able to negotiate the price just to make sure the buyer's happy and the seller's happy as well. And these are just normal things that I feel like we used to be able to do in the market before the pandemic, instead of having a property sit there for literally 2 days on the market and get so many offers. I remember I was one of the realtors that wrote an offer on a property in Danville that got 54 offers and was on the market for a few days, and I wasn't the winning bid. But seeing me having to compete, that was kind of frustrating, right? They're kind of like, look at these guys and what they're dealing with. And also, let's take a step back and remember that all sellers have to be buyers at some point, right? If you're going to sell, where are you going to live? Unless you're buying it all cash, you're
Oh
most likely
yeah.
going to find somewhere, right? And every seller that sells for that astronomically high price, well, they're going to have to go into, let's say, the Sun Belt and try to buy a retirement home, competing the same exact way. And that's pretty frustrating after a while.
Well, yeah. And then also I noticed a few agents don't, talk to them about, capital gains and when they want to sell property, and they don't understand, like, hey, you're not going to get all your money. So where are you going to retire? You want to relocate? What do you want to do? So it's always good, absolutely, to find out where your seller wants to move to. And I think
Right.
that's really good when you're negotiating, them to have someone buy their property and like figure out where they're going to go and what's affordable for them. So it's a win-win for both. And I've been feeling it a lot with my agents because they had been calling me, Heather, can you come to me to the house? And I'm all, okay, well, okay. Why do you want me to come to the house? Well, because you told me about the picture that they had. I had an agent that showed me her flyer, and the house is not even selling. It's not even moving. It's in San Jose. And so I go, okay, let's look at the flyer. And in front of the house was every single pot you could find at Target, with plants in it, or at Home Depot, or
Mhm.
they had pottery all over the front yard. And I'm going, okay, wait a minute. We need to let's go back and talk to your seller and find out, hey, when your buyer comes in, do they want these here, or what do you want to do? And so she goes, oh my gosh, Heather, I didn't even think about that. So now they're bringing in a contractor. I actually, gave them my little tip, and to fix the flyer, and redo the flyer, redo everything. And now she got convinced the seller, hey, we need to get them removed, we need to redo, we need to have a contractor come in. And now that's going through right now. So they took it off the market, and they're going to redo everything. And I really do, I really believe that you need to fix up these homes.
Yeah.
If you want to have, an attractive home to attract a buyer that is ready to go, and that, I'll I'll pay all cash. Or they don't want to fix up the house and move things, that they're just going to buy it as is. And I believe in that. Just like you got your inspections. That's like amazing. A lot of people don't care. No, just sell my house as is. And then all of a sudden they buy it, and now there's problems, and it gears
Yeah,
over to
right.
the agent. But you're on it. You're on it with those inspections. I think that's phenomenal.
I appreciate that, Heather. I'm a big believer of
Yeah.
if it's not selling, it's not compelling, and it has to do with every market, right? And you just, like you
Yeah.
mentioned, with helping spruce up the front yard, giving it some curb appeal, changing up some of the print marketing, for example, little things like that can definitely start getting people in the door, and they're like, oh wait, honey, well, we could totally change this, and this. I thought it was a lot worse. Yeah, we can change that, and boom, there you go. And I think in today's ever-changing market, as the rates are going higher, you had mentioned you had you had an agent, a colleague of yours who had the listing fall out, right, because of financing.
Yeah, it
It
was
seems
in
like,
the Glen.
right, a lot of people, like, if it's harder for them, like a lot of buyers are just getting frustrated, like, let's be honest here, that sometimes opens more people up to lawsuits. They want to get out of a deal, or the deal just closed and they see the rates going up and they're just upset, or they lost their job, they got laid off. They were, let's say, one of the folks at the San Mateo office of Tesla, the autopilot, got 200 folks got laid off, whatever, right? And they want to get out of this. The first thing they usually do, they'll never look in the mirror and say like, oh, I bought it at a bad time, whatever. They're like, oh, let me go and see how I can get out of this. I try to, put out real estate content and tips on TikTok. And there was a few folks that actually reached out to me, private message me, said, hey, can I get out of a contract where this, and this? And I said, well, I have to give them the disclaimer. I'm like, I'm not a real estate attorney. You got to talk to a real estate attorney. I'm just an agent who has a lot of experience. And I can help you with this, and this. But anyway, I ended up telling them, no, you can't. Like, what you're doing is the agent, from what you're telling me, did their due diligence in properly disclosing everything. You just decided after 3 weeks that you didn't want it anymore, but you had 3 days. You know what I'm saying?
Uh,
So, right. So my point in saying that is I feel like it's that much more important these days to make sure that I have inspections, to make sure that I have those sellers disclosures, and to have them sign off on it. Just in case in the future, I always want to make sure that I can build equity and keep my clients happy. Don't get me wrong, but some people are just can't be helped, or they're unhappy regardless. And instead of saying, yeah, I shouldn't have bought, they'll look at somebody else to blame. And you always want to make sure that you do your due diligence, you protect your client's interests and your interests as well.
Oh
Yeah.
yeah, and I've also real quick have noticed when people are in a nutshell, they need to sell their property. Number one,
Mhm.
they're embarrassed because of their life's changing and
That
styles,
makes
right? Because
sense.
they wanted to be kept up with the Jones back in the day. But I
Right.
have noticed an increase of foreclosures, and I have noticed a lot of people not paying their property taxes, especially absentee owners.
Mm.
That's
And
interesting. Hmm.
yeah, and we have a lot of really, really good marketing content to help those that are in need, and to help and understand like what is going on, what happened. And I think it's good information to give to an agent just like you, because you care and you want to help them, and you have that resource to go in and knock on their door and go, hey, is there anything I can do for you? Do you want to do another refi, or do you want to talk to Ed? Find out what's going on with your equity in your home, and not and stop that foreclosure, and stop that short sale, and stop that bad market that may be coming or increasing. And we have those resources and leads to help the agents go in and help the consumer, and to fix all of their financial needs. It could be they could sell, they want to relocate, they may want to rent out the property, they may want to do a 1031 exchange or leave out of
Mhm.
the county. But it's really good to educate the people that
Some
are in
options.
distress, and letting them know that they have options with you and your team to help them. And then we give that information to you and you run with it. So we help our agents get those leads and help those people.
Well, and if I may jump in, and
Please.
so let's encapsulate what's going on here, because when
Mhm.
the market changes and it shifts so dramatically like it has, I think what it ends up happening is that the cream, if you will, rises to the top. What do I mean by that? Well, it becomes very Darwinian. The days of easy money, like we talked about, where it didn't matter if the house burned down, it's going to go for 200,000 over. Well, no, that's not going to happen. We already talked
Right.
about
Mhm.
taking that house off the market and fixing it up, because it's not just anything that's going to sell. There has to be value in it. That's number one.
Exactly.
But number two is also the professionals that are out there. It's thinning out. And what it is that it's now teaching the consumer that advice, that education, and
Mhm.
that experience really matters now. It's not just, oh, my cousin who just got in to real estate a week ago is going to help me now, and that's why they don't go with Nima. No, that's not the way it works. You
Right.
need to have experience, education, and advice, and to give them these kind of resources, because we who have been doing this boots on the ground for so many years are the ones who sharpen our irons all the time and build alliances like the one that we're seeing here, that is able to then help those clients that maybe didn't think they could, or maybe they felt stuck. Like in this example of the person who walked away because of the rate, I mean,
Yeah.
they could have negotiated. Maybe the seller gives them a small credit to buy down the rate. Maybe you don't need to put all that money down and use part
True.
of them. Instead of putting 25% down, why don't you put 20% down if you qualify and use that extra 5% money and
Mhm.
buy down the rate? But, you got to show people that these options
Yeah.
are available out there and for the greater good, right? That we all go back to the table, go, look, the rate is too high for the client. Could you give, instead of lowering the price of the house, can you give my client or the client $10,000 for closing costs so that they can buy down the rate, whatever the case may be. And now everybody's happy,
Now,
right?
Ed, can you, if I can take a step back, can you unpack that a little bit more when you say
Yeah.
buy down the rate, like what that
Yeah.
means?
So here's what happens is that in any given day, and this is something that most people don't know about, is when you ask, most people say, well, what's your rate? Well,
Uh-huh.
first off, there's no singular rate. Okay.
Mhm.
There are rates. On any given day on the rate sheet, you have between 10 and 23 different interest rate options. Now
Mhm.
you have what is called par. Par is the interest rate that does not cost you any points for that rate. Okay.
Hard.
Now, any rate below that rate is going to ask for a premium. It's going to require a premium. It's kind of like buying a car, right?
Uh-huh.
If you want leather, it's going to cost you a little bit more than the seats that come fabric, that come as a default, right? Any extras, you're going to pay for that, right? You want turbo, well, that's going to cost you more than it's normally aspirated engine, right? The
Right,
same thing
right, right.
happens with rates. So you have 10 to 23 interest rates on any given day as options, and some will cost you money, some will give you money back, and then there's the par that doesn't cost you anything. So any rate above par will give you money back. So for example, let's just say hypothetically that the par rate is 5% for a 30-year. Let's just say, right? If you are willing to take a 5.5% rate because you need the extra money that rate gives you back, you need it for
Mhm.
closing costs, that's one way of getting creative. But if you want a lower rate than the 5%, it's going to cost you points. Keep in mind, 1 point is equal to 1% of the loan amount. And
Okay.
it's not always that linear. It's not always a full point. It might be 3/4, it might be 7/8, it might be, a fraction thereof. But my point, pun intended, is that everything's negotiable. So what you do is you maybe put some of the down payment instead of putting all that down payment, put some of it towards buying down the rate, paying the points to get a lower rate, or you
Yeah,
just talk to somebody, talk to the seller and say, hey, are you willing to do this so we can keep this deal? Maybe you can give me
yeah.
$10,000 credit so that I can use that money to buy down the rate. Now, keep in mind that points are not lender fees. That's money that you pay the market, the interest rate markets. It's a premium that you pay to get a lower rate, and that's why we call it buying down the rate, because you're using money to buy down or pay for a lower rate. Does that make sense?
Ah, yeah. Thank you for that breakdown. Yeah, because I know that there's certain, and like let's say institutional lenders that they might be like selling, maybe two, three products, maybe even one. And then there's folks like you, and that's why you're called the mortgage ninja, because you just have all these different options, right? And going back to the subject property that Heather was talking about in Willow Glen, if this was like a $3 million home, like a new build, completely brand new, and you might be interested in getting a 30-year fix on a property like that. Let's just say you're like, no, this is going to be my forever home, right? Okay, fair enough. But it could have also been a townhouse or like a two-bedroom condo. And let's just say if it was the latter, and you weren't planning on staying in this property for 20 years or more, what other options can folks go through? Because I feel like, Ed, depending on how long you want to stay in the property for, you can go through an adjustable rate mortgage, like full disclosure, I did for my house when I first bought it, or you can go through like a 30-year fix, like my dad loves to do. What are the options between those? And let's just say high level overview of when to use it.
This is a great topic because most people default to the 30-year fix. Why is that? Let's talk about the psychology. Why is it that you didn't
Hmm.
even hear anything else except for 30 years? That's all you care about. That's all you talk
Yeah,
about.
yeah.
There's no strategy. You're not even asking questions. Here's why: the false perception of safety.
Mm,
Here's the truth. Now, you mentioned something that's interesting, and we kept it to that one lane, which is how long are you going to keep the property?
mhm.
But wait a second. Just because you're going to keep it forever doesn't mean you should keep the loan forever. Because here's what I'm going to say to you. How about if in 5 years you have $500,000 of extra equity that you did not go to work for? You slept into that house, the house and the market made you $500,000. Okay, talk about nice passive income,
Mhm.
right? In
Absolutely.
reality, you're telling me that you're not going to do anything with that money? You're telling me that you're not going to take the advice to go see a financial advisor to see what you could do with that money? Because let's just say that the rate is 5% still, but you could take some of that equity and invest it at a 7 to 14% clip, but it's the cost of funds is only 5%. And if you're making 10%, you're making an extra 5% on that money.
That's what we call house hacking, ladies and gentlemen.
Well, this is an at large, and I'm not saying everybody
Yeah.
to do this, right?
Right, right,
So,
right.
but what I'm saying is that just because you're going to keep the property doesn't mean you keep your financial strategy static, right? You want to do something. Maybe you've been dreaming about starting a business and you don't have the funds in a checking account, but you have it in
Mhm.
the house, and you know that that business is going to make you a certain amount of money. Then maybe that's where you sit down with some extra folks, right? Some other advisors, and
Mhm.
talk about having a strategy. Now, let's just say though that you're ultra conservative, okay? That 30-year fix is your thing, but you tell me, Ed, here's the reality. I am going to sell this property, most likely, high probability within 5 years, because I'm relocating to Seattle from
Mhm.
San Francisco. And you know what? I'm not going to keep this property. I need the
Yeah.
proceeds from that property to buy in Seattle.
Oh,
So here's
we're
what
going
I'm
to
going
be
to say to
parents by that time. I'm so sorry to interrupt you.
them.
We have a 2 bedroom apartment. We use the other room as a home office, but in 5 years,
Okay.
our plan is to have children. So we're going to have a
Yeah.
bigger.
Oh, we're going to upsize. Exactly. Okay. So, but we know we're not going to keep the property.
Mhm.
So you say to me, for sure, it's going to happen in 5 years. Now, we all know that you got to keep a little bit of a delta there. So my recommendation in this case is not to go with a 5 year uh, ARM or adjustable rate mortgage. I'm going to say go with the 7 for 2 reasons. Number one, I'm giving you an extra 2 years in case you need it. That's always good, right? Give
Yeah.
you a little 2 year buffer. And two, because the 7 year is usually priced nicer,
And
right?
what,
But
what would
again,
that
we're
be
going to
in
go.
today's market, Ed? I'm sorry, just for
Go
the
for it. Go
viewers,
for it.
I want to give them, and
No, 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 no.
you're
This
on
is
a
this is
roll
good.
here,
You
and
want
I
to catch it
love hearing it, and I love that
as it
passion when it comes out.
clicks.
So let's say 7-1 today, high level, like within the
Yeah.
past week, a 7-1 arm compared to a 30-year fix rate.
Okay, so a 30-year right now, and we're at Monday. I just priced a loan. We're going to be between 5 and 5 1/4 on a 7. It's going to be about a quarter to 3/8 lower. Okay,
Okay.
so instead of being 5 1/4, it's going to be 5
So
around
that
there, right?
basically means even though you know for a fact that you're not going to be in the house for 30 years, you don't have to do anything and you will save money just by getting a different loan option.
Yeah, and keep in mind, so here's the thing, because it's kind of confusing. I'm saying you're getting an adjustable rate mortgage.
Mhm.
So what's the 7 mean? So in this situation, this example, a 7 year ARM or adjustable rate mortgage means it's fixed for the first 7 years, which means it's not going anywhere. That rate's locked in for the first 7 years. After 7 years, it goes up once a year. It adjusts. It doesn't necessarily mean it goes up. Most of the time it does. It could
Mhm.
technically go down, but most of the
Yeah.
time it does go up. So that means it's going to adjust every year for the remaining 30 years, meaning
Mhm.
in this case, because they're all 30-year mortgages, it's going to adjust for 23 years. So fixed for the first 7, and then adjustable every year for the remaining
Yeah.
23 years of the 30-year term. On a 5, by the way, it's fixed for first 5, and then it adjusts every year for 25 more years, right? Because they're all 30-year
It's still
fixed.
a 30-year, huh?
Yeah,
7-1 arm is
it's
still a 30-year loan.
still amortized over 30 years, right? But it's fixed for that period of time. So when you hear a 7
Mhm.
arm, 5, 3, or a 10, those are the fixed periods at the beginning of
Mhm.
time, right? So in this case of our example, person's going to leave in 5 years. They don't have to worry about that rate for 7 years. So if they need an
Right.
extra 2 years, they got it, right?
Yeah.
Sometimes you know how plans are, right? They never end up exactly the way we plan them,
Yeah.
right? Like budgets, right? You know, you're going to build a house, it's always over budget and it takes more time, right? You want to buffer that in. But again, this is not a one size fits all. And I want to hammer this home that this is where expertise, advice, education, and handholding kind of service really comes in place. Make sure that when you're doing a transaction with someone and a professional, that they're more relationship focused. They're more education and advice focused than just rubber stamping it like they're in some kind of car factory. Does that make
Right.
sense?
Yeah, absolutely. Now, let's just say, as you said, things change. You never know. We don't have a crystal ball. We go off of forecasts, let's say, right? They get a 7-1 arm. After 5.5 years, they decide, you know what, we're not going to move to Seattle. We're going to stay here. Or unforeseen circumstances, the couple ends up splitting up. So no, we're not going to have a child because we're getting a divorce. And somebody's just going to, stay in the property and take on the loan. What can they do in that situation,
They
Ed?
can always refinance. Remember, there's no
Okay.
prepayment penalties to these loans. So you can refinance. Again, we sit back down and say, hey, okay, so life threw us a curveball.
Mm-hmm.
Now let's win knowing that there's a curveball. So we refinance and we look again. Who's going to buy out who? Are you just going to sell and then you want to buy? And then when you go and buy, how long do you think you're going to keep it? And here we go again, right? With
Right.
strategy and putting a plan together based on the curveball that life has dealt us. Now keep in mind that nothing is permanent except death. So you
Death and
always
tax.
have options, and professionals who care about you will always have advice and options for you, right? So, and even let me just go out on a limb and say this. So let's just say you don't like today's rate, right? Because rates have been going up, right?
Right.
Even though lately they've been coming back down, but rates are not at 3.5%. Okay, who says you have to die with that rate? That's a get into the property and collect equity money rate. But then if rates come back down in the fours, which I think they will, then refinance. Use some of
Yeah.
the equity dollars, because I always am a big believer in using equity dollars instead of income dollars. Let the
Mhm.
house pay the closing costs to refinance. Because let's just say that the closing costs are 6 grand, just for the sake of conversation, right? It's going to cost
Mhm.
you 6 grand in the near future to refinance. Well, how long do you think it's going to take your house to appreciate 6 grand? I think it just did. 30 seconds in these
Yeah,
areas, in
during
these
that,
neck of
yeah,
the
I was
woods.
gonna say during the first
So
week
how
of
much did it
escrow.
really cost you? Nothing. The house paid for it and it already made it
Yeah.
up. See, this is
And-
big picture thinking, right?
yeah, yeah. I was gonna ask Heather, have you experienced anything like that? Have you had any buyers come to you and say, "Oh my God, my home is appreciated X amount during the escrow period at all?" Because I've gotten those before. I'm not sure on the title side.
You mean when the buyer actually purchased it after or during?
Yeah, like let's just say after they get into escrow and they meet you and they're signing off towards the end. And
Mhm.
I mean, we tend to talk a lot more to the clients during the escrow period. I feel like because we put them in the contract, we're still going through the disclosures and getting their loan approved. And so we're talking finances, right? And I'll get
Right.
those comments like, "Oh my God, Nima, it seems like my home's already gone up in value since we got into contract," things like that. So I'm not sure if you've ever had any of those types of conversations at the signing table, but they are pretty nice.
Well, I'm not an escrow officer, I'm an account executive. So,
Oh, okay.
but I actually talk to the escrow officer at times.
Mhm.
And when if the escrow officer is signing them off, they usually hear a little bit like, "Oh, I bet you our house is going to get into having more equity in probably in about, I would say, 3 weeks or a month. I bet you we're going to go up in equity." So they like nub each other, but we've heard that. And then also the notary is the one that actually, we have special notaries that go out and sign off the client because of COVID. So they actually go out and they meet the client either at the real estate office or our office or wherever they desire. And I have heard of notaries telling me, because I'm friends with them, and they say they feel like they got this deal. They they negotiated it down. They feel really happy about it, and they're walking away with a little bit more equity, and they actually appreciate the agents that help them and getting into their home. So we've heard stuff like that.
Okay, I see, I see. Yeah, because
Yeah.
I've
The
had,
notary, you need to ask that question totally too, and the escrow officer. But
yeah.
true, because once they do sign that, they know that they're getting a good deal. They know that they
Yeah.
are. It's a really good market, and you know what? It's just, it is what it is right now, because I know that terminology, people hate it, but it's true. The interest rates are up, and again, people, want to fit their lifestyle, what they can afford. You don't want to put someone in a home that they can't afford, then we're going to be in big trouble. So that's definitely where Ed comes in. He's going to look at Mortgage Daily News and find out, okay, which is a good, option here. Is it a 30-year jumbo, right now at 4.76, or is there a 5-in-1 arm that they can go into? That's not a 30-year fix, because for me, I have not lived in my home for 30 years. I moved 3 times in
Right.
my,
Yeah.
5 to 7 years is the average.
pretty much.
So there's not enough conversations about these things, in my opinion, right? How many options
agree.
you have? They always look at that, and guys, there's different options out there. So you just got to know
Tons.
really with what you're dealing
A
with,
risk taker or a conservative.
Right. There's so many things that you can say. Ed and I on previous chats, Heather, we've said fortune favors the bold. We've also said you're always paying a mortgage, either yours or landlord's. You know what I mean? You're always right? So
Strategy matters.
strategy
Education matters.
We
Experience matters, right?
we
Talk to
talk
the-
about living in a home, being able to write off your interest rates, for example, PMI, if that applies to you, your property taxes, right? But then we also don't talk enough, because we don't work in the rental space, but the unfortunate rental inflation that so many people are dealing with every single day now. Rents being up nationally, I believe something like 30%, I saw somewhere, right? At some point, you're like, dude, like, where's this money going, right? How are you investing in your future? And shout outs to everyone. My heart goes out to you if you're not at the place to be able to buy at this point. But I really implore you to, as soon as you can, at least have a payment plan. With guys like Ed that we've talked to before, like, he can get you on a path to start going in that direction.
That's
least
the key.
planning, right?
Can't do it
that.
today.
You know
Let's
what I
prepare
mean?
you for tomorrow, because tomorrow's coming fast.
Yeah, like
And creative financing, right?
creative finance.
If you got a fat 401k, you could take that out and pay back the loan every month for, I don't know how long you want to do that with your company.
Plus, we don't even count that as debt, because it's your own money, folks. So it doesn't even hit your debt to income ratio.
Yeah.
That's a good to take out to put down on a down payment.
Right.
Absolutely.
Yeah.
Or
Yeah.
estate planner, your CPA, or maybe those people that, I know that, real estate agents are going after empty nesters, and they're not putting this is a whole different subject, but they're not putting their house in a trust. And then when someone passes away, they have to pay, the spouse has to pay taxes. So, it's hard, because then they need to move, but then they don't know what to do. They're in a situation. So a lot of people right now that are 55 years and over, they're selling. And there's a lot of things coming up like that right now.
So
A lot
speaking
of
of on the title side of things, right? I recently had a transaction, that same exact one I was telling you guys about, that off-market transaction in Santa Clara. This buyer, my client, he bought a piece of land in Morgan Hill and apparently had a bunch of liens on it and an easement. Now, I wasn't representing him in this transaction. I have no idea who did and what he ended up doing and how he inherited a bunch of liens that he constantly has to go to the county. But he got very, very paranoid during the transaction. He wanted me to ensure that he wouldn't be acquiring or taking on any of these liens if the seller potentially had any. So I bring that up, Heather, because I wanted to break down title insurance and essentially the options that are there, high level overview for our viewers. Like, what does title do in the transaction, right? What type of options they have for title insurance, and what that essentially guarantees them taking on that property.
Okay, so first of all, usually what I like to do, I like to actually run a full property report and pull up all the deeds against the property and check with my title department as well, to making sure hey, is there any liens on the property? So she'll pull up every single document and send it to me. I send it over to the client, not the seller or the buyer, to the agent. And also I send it over to the escrow officer.
Mm-hmm.
Then what we do is we look at and find out, okay, what kind of, we kind of get an alert a little bit of like, oh, hey, it's in foreclosure. Here's a reconveyance that's missing, or there's a cloud on title. So I actually call customer service first, and then we'll open up an order. We'll open up the prelim, which means we open up escrow with an actual person that sits behind the desk. And she communicates, or he communicates, with the actual chief title officer within our company. We have 2 of them, and anybody can call them on the phone and talk to them. They're like attorneys. Okay, they're real estate attorneys, pretty much. And so what we do is we pull the prelim. We look at on the prelim if there's any type of liens or mechanic liens on the property. Okay, what we do is we communicate to the title officer, and they look and they communicate with the court recorder's office. They go back and forth. They find out where all these liens are, how they came. Okay, we have to clear those liens for that buyer.
So you'll contact the seller and say, hey, listen, these are outstanding liens. We can't have you release this property until these are paid, something like that.
We need to clear the title. It's the CLTA. It's the California Land Association policy ensures the property of the owner. And then the ALTA is the American Land Association. It is extended coverage that ensures the lender against possible unrecorded risk. Excludes in the CLTA policy. I have all that information. If anybody has anything that they want to talk about, I have it here, and it's called Home Seller and Home Buyer Guidebooks that I have. But what we do is we go back and forth and we communicate to the title officer. We investigate and how to remove all of these liens before we move forward. I have worked with 5 agents the last couple of months. Unfortunately, the title companies did not want to move forward.
What do you mean by that?
They did not want to be responsible to open and close the escrow.
So it had just a ton of liens. It was a mess.
Pretty much.
Wow.
And
Okay.
so we took over. My escrow officer investigated and went back and back and back and forth to figure out all these different liens on the property. It could be a reconveyance lien that the title company didn't want to investigate. We got that removed. If there's liens that are with the feds, that's with the feds. So we have to be careful because they have to get paid first, right? It could be a lien also if somebody didn't pay child support. It could be a bail bond. It could be a contractor that didn't get paid. So we have to find out and go back and do a lot of research. We get it done. Our title officer, chief title officer, investigates everything to making sure you are aware as the agent, and also the seller, so we can get everything cleared and ready to go to close escrow. We clean up everything, and we're our own underwriter, and we're national.
Wow. That's really good to know. Thank you. Yeah, because sometimes you see those acronyms, right? The CLTA and ALTA. Now,
they're 2 different ones. It's an extra risk for the lender that ALTA is. Is that right, Ed? Ed?
Oh, sorry. Ed's
yes. Yeah, I was on mute.
Oh, that's okay.
So that's more of a risk. So the ALTA.
It is more of a risk.
More of
Think
a risk.
about it. It could open up for litigation.
Okay.
Later.
Yeah.
And also I want to address another thing too, that a lot of title reps, not a lot, but just a few, I shouldn't say that, different title companies, sorry. I just wanted to clarify this. So different title companies out there just do the standard CLTA. We actually have the full coverage of the CLTA. And I would love to share that with you.
Can you tell us the difference?
Well, I have to pull it up, and what it is, it actually covers everything of the property. And I have a form, and it's a PDF file, and it breaks down exactly the ALTA, the CTA, ALTA policy and the CLTA, and the full coverage. The full coverage is amazing, especially for agents, because if they purchase that, there's an actual verbiage in there that protects the agent of getting sued. for anything.
Wow. Okay.
And it
Interesting.
also can be like someone planting a certain type of plants, or covering the whole property. I mean, it's in detail. You want to have and speak to a title officer for this.
Yeah.
Okay, because everyone has their own lane. I have my own lane, that's marketing, building relationships, and educating.
Mm,
Then I also have the escrow officer. She has her own lane of closing the escrow, communicating back and forth with the title officer, getting
right.
everything ready to smoothly. The title officer is the one that's in charge of making sure everything's cleared on title and protecting the agent, the seller, and the buyer, everyone involved. It's
Mm,
amazing. We all work phenomenal together
yeah.
and get it done. I've closed 5 transactions last month, and they were over at least like 1.9, 2.9, 2.5, all in those range for those agents and those sellers, because the other title companies wouldn't help and remove the liens.
Wow. That's good to
Yeah,
know that there's different options, right?
but
In case if somebody can't do that, right? If they're just like,
and we
whoa,
can
this is too much
try,
of a mess for me.
but if there's a situation, we don't want the agent to be at risk either. We
Right.
want to protect everyone, and we have to find out and seek and understand and educate. And
That's the
that's
key.
That's right.
That's the key. So in this
but you
situation
got
where somebody
that.
would have just bailed because they saw something and they freaked out, here's
Right.
where Heather and WFG Title comes in and says, well, let us do some research first before you call it a day and see if we can help.
Yeah.
Yeah. I
Love
totally
that.
agree.
And then if it's not the right time for that, but you can go in and fix it, and then go in and then help them in the near future. And not only that, you'll get
Of
referrals because
course,
you help
Right.
them.
because you went that extra mile. Then that's the
Absolutely.
key. This is how you tell when somebody says they're relationship focused versus when they are. When they
Absolutely.
are, they go the extra mile, right? When they just say it, then they don't return calls or you don't hear from them, right?
Yeah,
Or they
absolutely.
just don't present any other options.
Yeah. And shout outs to, because I don't know about you guys, but my lender, although he does have a family and stuff, he knows that when business needs to be done, sometimes you got to chat in the evenings here and there, right?
Or
Because it's all about the
Sundays
client, or the
at
Sunday
7 or 8 o'clock at night, it doesn't matter. Yeah. No, it is the way it is because we're
Yeah.
talking people's lives here, right?
Yeah.
At the
Yeah.
end of the day.
Well,
And
guys,
and I honestly think communication and seeking and understanding and
Critical.
help that is huge, and that's going to build your
mhm,
referral business. I've seen it in the business for 20 years, and following up with them is key. But our title company is amazing, and you can actually talk to our title officers,
I
and
love
they
it.
will guide you.
And by
WFG,
the
huh?
way, I can tell you firsthand, Heather's always been available. She's always been a great resource. Any questions that I have or I need something, she's always there. And there you go. Actions speak louder than words.
Nice. So
Thank you.
WFG, World Financial Group.
Oh no, it's Willison Financial Group. So Pat Stone
Okay.
was the CEO of Chicago. No, excuse me. Pat Stone was the CEO of F&F, Fidelity, Land America, all of those groups. He was the
Mhm.
CEO. And then he did the merger of Chicago Title back in 2000. Well, he formed his own company in 2010. We're a national company, and our financial institution is Willison Financial Group, over
Got it.
$17 billion, and we don't even have any claims against us. So our pricing is fair, and we're lower than anyone else right now.
Well, I hope that we can do some business in the near future. I appreciate you tuning in and giving us your 2 cents from the title side of things. I've been wanting to have a good title rep like yourself on for a while now, just to break down some of the differences, right? And just help educate some of our viewers the difference between the real estate, the lending, and the title side of things. So, big shout out to my co-host Diaz for being on the call and always dropping a whole lot of knowledge. Something tells me that you've
Oh,
been a
and
stockbroker and a lender for a long
thank
time.
you all as well, because
Thank
look,
you.
it
Thank
takes a
you.
village, right?
Yeah, absolutely. Well, I appreciate you guys tuning in for this week
Thank
on
you.
How's the Market. And we'll be joining you guys back in 2 weeks. I hope you guys all have a productive rest of your week, and
You as well.
chat with you soon.
Thank you.
Thanks, folks.
Take care.
Appreciate it.
Bye-bye.
Bye now.
Bye.